Hey, good morning, everyone. Marty Missouri here. It's Thursday, the 3rd of February, 2022, with just a super quick technical update. This is for those of you who I know seem to enjoy these technical analyses. We've been looking both at the short and the long term for the equity markets, and then throwing in gold and the dollar and other things from time to time. I want to preface this with just kind of a side note to clients. The short-term stuff that we do here, technically speaking, it helps us in guidance relative to clients' short-term expectations. Also helps us with entry when we have new money to allocate. Sometimes we'll have what we think is a really good long-term fundamental idea, and we'll look at the technicals, and that'll either keep us from entering that position, or maybe having us start with a very small position and scaling in if the technicals tell us that we might have the opportunity at a lower price. So for this morning, we're just going to take a quick look at the S&P, the NASDAQ, and the dollar. We're going to start really short duration on the S&P. We'll just look at the daily on the NASDAQ, and I'll have a couple of screens I want to share with you about the dollar. So 60-minute chart, 60-day, 60-minute chart for the S&P 500. As you may know, the market's having quite a tough time today. That was actually signaled here in this 60-minute chart. There's your rising wedge pattern. There's the moving average convergence divergence, or the MACD, rolling over. That's a sell signal right there. And got a little overbought here on the RSI. And then, of course, it rolled over. So big gap down this morning. Of course, we know that that is all about, or largely about, Facebook's big whiff yesterday in terms of their earnings. After hours today, we're going to hear from Amazon, right? So that could reverse this in a big way, or it could accelerate it to the downside if Amazon, happens to miss. So right now, the short-term setup is not looking good for the market over the next few hours, if you will, if not days. But of course, as we've identified here, nothing always works. These short-term indicators, as we've been doing the videos of late, with I think just one exception, have been pretty spot on, the latest included. Looking at the 2-hour chart, 60-day, you have essentially the same thing. You've got your rising wedge, right? Broke out hard this morning, gapped lower. Rolling over here on the MACD, don't quite have your sell signal here. And then, of course, the RSI rolling over as well. So again, on a really, really short-term basis, tough-looking charts for the S&P. Looking at the 1-year daily chart, the bear flag pattern that was looking very classic right here has not panned out. So that would be a failed bear flag pattern, right? And I did mention, if we break above this resistance right here, the 200-day moving average, we would accelerate. And ironically, I drew this resistance line right about there. And sure enough, we broke through that. And at least at the moment, for 1 day at least, looks like that's a failed breakout. And also just below the 50-day moving average, which is sloping lower, and that's not a good technical sign. Now, if we come back through here and break below the 200-day moving average, which might happen, say, if Amazon surprises to the downside, or the jobs number, for whatever reason, freaks people out tomorrow, that would not be a good technical sign. That would be not a good thing to see the market crash back through the 200-day with momentum. That would be a failed breakout. And as I often say, there's nothing worse than a failed breakout. Somewhere down here, folks, you're going to have some stop loss orders that will trigger. And a stop loss is an automatic sell when the market hits a certain level. That could exacerbate the downside. And then if you exacerbate the downside, then you have a whole other realm of risk that is embedded in options dealers hedging. So we've gotten into that in the past. But there could be an acceleration if the sellers of, say, S&P put options have to short the security that they're exposed to. That works in both directions, with call sellers to the upside, put sellers to the downside. And this was quite the story recently among the meme stocks, right? The GameStops, etc. And I did quite a lengthy blog post on that, just kind of explaining that dynamic that I know a lot of people gave us some good feedback on. So next time you look at this, that bear flag will not be there, and we'll be looking at other patterns. In terms of the MACD, that's a buy signal. And remember, I said we're oversold right here, so that would suggest that a pop's coming. Well, we got that pop. You had really good earnings from Google, for example, and that helped a lot, and other companies as well. But at the end of the day, you still have these divergences that are playing out right now. Lots of technical damage here to be remedied before you would get really bullish about the market. The NASDAQ Composite Index, just the one-year daily chart here, still not looking good. You know, it broke hard below the 200-day moving average. It had its flag pattern here as well that is now broken above. Again, we had this strong resistance line, and just like we did on the S&P. But the NASDAQ really hasn't even caught back up to the 200-day moving average. So this is not a good look. And it's down at one point like 3% today. The NASDAQ 100 is down 2.8 as I speak. And again, I'll tell you folks, there's been a lot of money made in these markets, and the NASDAQ is where, you know, the big concentrated positions in the S&P are also captured. So this is really the one to pay attention to. And remember, our biggest concern was this chart right here, and that was the breadth, the advanced decline line for the NASDAQ. We started bringing your attention to this when it started rolling over, and that's just a really, really, really ugly look. And when you go back and back test that, you can, you can bet that bad things are coming when you have such bad breadth. And essentially, very few boats were rising with the tide right here. And then lastly, two charts on the dollar. This is the one that we normally work off of here. Yeah, as you know, regular readers and clients, we are long-term bearish on the dollar. Technically, it's come up, it's tested this very important 50% retracement from these highs. You go from the high to the low, and then you begin retracing. Looks like it's failing that test right here. Just dropped below the 50-day moving average. Huge bearish divergences in the momentum indicators. Today's big drop has to do with the results of the European Central Bank meeting today and the press conference. The euro is the biggest counterweight within the dollar index, so you watch the euro very closely to see what the dollar may or may not do. So yeah, we maintain our longer-term bearish view of the dollar, and it's not necessarily consensus. What I'm reading, it's kind of split down the middle. A lot of people are bullish on the dollar, and I understand why, and I appreciate their theses, and I pay very close attention to them. The other chart, I actually created this in response to one of those very adamant dollar bulls going forward. He makes a good, interesting case for why the dollar is going to be stronger. He presented a chart here recently, and what he had was this big, downtrend line that he started here and then caught right down here. And then he showed these areas right here of support, and he had those circled, and then he just showed it breaking through that trend line. And I just to play devil's advocate, and not in a snarky way, but just to say, let's just look at it a little deeper. And so I added the retracements here, and I basically created a chart where I pointed arrows to the 62% retracement, and and said, essentially you need to watch out for that. And very easily could have and could still come roaring through that. So we came through there, didn't quite hit the 62% retracement, have this nice downtrend line that got broken. And the bulls got very optimistic, and then right now disappointed because we've broken right back down through there with some momentum. So you break down through these levels, and then you're going to have something, notably further down to go to get to any, meaningful resistance. There's a line right there we probably should draw as well. So, but rather than being, adamantly bullish or bearish, and I need to just speak for myself, and I can't speak for anybody else and what they may be doing. We want to look at these things objectively. We have a fundamental view of the dollar that it will and really needs to go down over the next few years, and that supports what we're expressing in our core allocation for clients. But it's all data driven, history driven, and not emotionally driven. And so we've got to look at these things. Like I have to look at this right here and say, okay, this really supports our narrative. But, you know, there's still maybe this uptrend line here, and if I work it, we haven't quite broke it yet. Could be a test, and if we succeed that test and get back through there with some momentum, suddenly, you know, we're off to the races. If the Fed gets more aggressive and the economy heats up and suddenly everybody wants to buy U.S. equities and other securities, well, that's going to be very bullish for the dollar. So we have to consider that, and we have to look for signs of that as well. So far, for the most part, we're seeing signs that continue to confirm our longer-term thesis. So folks, I will leave it there. Thank you as always for watching and listening. Tomorrow or Saturday, you'll get this week's macro update. Not sure yet whether it'll be a video or a written blog post. Thanks again. Have a great day. Bye-bye.